Let me start off. Viral, welcome once again. So my first question, of course, is that the IMF, I think in its October projections, projected that the Indian economy would contract by about 10.3% current year. And this contraction is much more severe than what some of the other emerging markets have experienced. Can you give us a sense of why the Indian economy was so badly impacted by the COVID when compared to some of these other markets?
Yes, firstly, thank you, Chetan, and thank you to all the students who are here for inviting me. As I was just mentioning to Chetan, this is my third interaction with IIM Bangalore since the release of my book. I guess I've become a traveling salesman, an electronic traveling salesman, often knocking on the same doors. But yeah, coming to the IMF projection, I have a very simplistic view on this, which is that ultimately the economic outcomes in the COVID year are deeply intertwined with the health outcomes. Countries that have had fairly bad infection curves have had to actually adopt containment measures or non-pharmaceutical interventions, as they are called, in the form of shutdowns, lockdowns, quarantines, uh, now curfews, etc., which are in line basically with your health curve. What happened, I think, is that in the Western economies, the initial shutdowns managed to actually bring the infection curve down temporarily, but then we have seen a resurgence. In case of US, it looks like now we are on what technically looks like a third wave. In many countries in Europe, it's a second wave. India, in contrast, just had a sort of exponentially rising curve up until, I would say, mid-September or third week of September, and I think the trouble with the exponential part of the infection curve is that it's very hard to project, because there are errors in testing, there are errors in the number of cases, there are errors in sampling as to whether you are getting to the right numbers or not. And when something is growing exponentially, any small error like this is going to amplify your projection errors very, very significantly. So I think India did adopt, in my view, fairly draconian lockdown. It actually ranks as among the most stringent as far as the initial COVID measures was concerned. And I think, unsurprisingly, that resulted in a very significant contraction of economic activity. Two minor points I would make is that perhaps our lockdown was a bit chaotic in the sense that it was announced with very little notice. That led to, I think, a fair bit of chaos, especially with the migrant laborers, and they had to go back. I've always had this view, but it got reinforced during my RBI term, that India B helps India A function productively. But when India B is not around, India A is not used to doing dishes and washing clothes as I am in the United States. And so I think that, probably the combination of this had very significant impact on the Indian economy. I think it had to adopt a slightly newer mode of functioning. Working from home in India, yes, we have greater digital penetration, but I know of a lot of tech people who don't have the right facilities at home actually to be productive from their homes. They don't have space to themselves. In many cases, the bandwidth is also not that great. The third minor point I would make is that I I do worry that the initial conditions of India, which is that the growth was already slowing down quite significantly, at least for 3 years leading into the COVID, is something that the rest of the world, and including many in India, have not embraced wholeheartedly. They have not been earnest in recognizing that perhaps India was way short of its potential growth, and maybe even potential growth has come down actually to an extent, even pre-COVID. And so if you haven't factored that in, so if you don't recognize that there was a declining trend line even without COVID, I think the COVID would actually produce a larger correction possibly, and that could have also contributed to maybe the COVID has brought the home truth in a harsh manner, that things are not that rosy on the growth front.
Okay. Right. Just following up on the question on the Indian economy. So India sort of was also hit by a double whammy, right? So in addition to the slowdown, we also have had to contend with high inflation. So our inflation numbers are now over 7%, so far above our target of 6%. And what is even more surprising is that while for most economies, core inflation has been stable or declining, in the Indian context, core inflation has also been rising. So can you explain for our audience, this seems sort of unusual, at least, given that there's a slowdown, why we have this spike in inflation, particularly core inflation? What do you think is happening in the economy?
See, again, it goes down to, I think, pre-COVID conditions. I think inflation started hitting 6% and higher levels right since last November. When I was at the Reserve Bank of India, you can see it in my minutes, which are published in the book as well, that I was consciously trying to make the point in my last three monetary policy meetings of February, April, and June 2019 that we should not take the food inflation that was benign at that time to be a given forever. It was so low at that point of time that based on historical data and the way that the sawtooth wave of Indian food inflation behaves, my conjecture was that food inflation had only one way to go, which was to rise again. Because what happens, see, think about a farmer. Suppose the food prices collapse. Generally, retail expectations are very adaptive. They are based on your most recent price experiences. So once the farmers see very low prices, they reduce cultivation of that particular crop. Now, every small farmer may not have the flexibility to do this, but that's what the country does as a whole on average. They withdraw from that, they plant into something else more. What that tends to do is that it creates a sawtooth wave in food inflation, which is that the farmers are always reacting to the prices of the last season. And so wherever prices have gone too much down, they tend to do less there. And then because of lower supply, the prices tend to rise. So I'm not surprised at all that the food prices actually rose the way they did in November, December, January, etc. A second key factor, and this is I think this is the more important point about inflation, at that is that core inflation hadn't really come down, even at the time when the food inflation had actually come down very significantly. And this was one of the other reasons why I was leaning against the wind of very substantial accommodation and saying that we should switch necessarily to an accommodative stance for a very long period. I had resisted moves to pump in a ton of liquidity into the Indian financial system as well through RBI's purchases of government bonds, etc. And all of my resistances were coming from the fact that, if core inflation is 3.5% to 4%, you are still within striking zone of what is your inflation targeting mandate. Now, one reason why core inflation tends to rise in shocks such as COVID further is because the government actually tends to face very substantial fall in its revenues because of the growth slowdown, and it tries to compensate for this fall of revenues by raising fuel taxes. So the fuel prices may be coming down in the rest of the world, but the government actually increases the fuel taxes in order to ensure that the price of oil doesn't actually come down. Now, in other economies, when growth is collapsing, their fuel prices are also collapsing, but that's not happening in India. In India, sometimes fuel prices even tend to rise in times of stress for the government financing. Now, fuel is a very important component, even though technically it is out of core inflation, it affects transportation cost of goods, it affects all the freight expenditures and so on. And through that, it has a very quick generalization into prices of all other goods in the economy. The third point is that, of course, COVID created massive supply side logistics issues, both in food as well as in other kinds of products. I know that even the books that were getting ordered on e-commerce websites were not getting delivered or in a timely manner. Now, of course, that's not necessarily inflation, but I'm just saying that it's not measured inflation. But what I'm saying is that there were logistics issues on the ground as well. So I think the logistics issues, which are hitting all economies and causing some inflation pressures there, are compounded in our case by the fact that food and fuel, which are the biggest in forming inflation expectations of households, are actually not looking benign at all as far as India is concerned. And I stress this. I've said this many times that I used to ask my mom on a very regular basis, what is her, we are Gujarati, so I used to ask her, Mongwari che gare, badi vastu aave je ma, and she always used to say, ha. She would always go by prices of vegetables. That is her sense of the inflation expectations. The price at the petrol pump is in your eye. It's a big expenditure you undertake every week or every 2 weeks, and it hits you, and it starts ratcheting up your inflation expectations. Then that gets built into wages and so on. So I think our inflation trajectory has not been that benign for a while. It's being sidestepped right now, in my view, by those who are in charge of monetary policy by saying this is all supply side driven. We have deflationary pressures coming down the line. I'm not so convinced, but at a minimum, I would take a more risk management approach to this, which is that when you are close to 1 to 2 percentage points above the upper band of your target, this is not even above 4%, which is your mandated target. You are above 6%, which is the upper end of the target. You've got to be a bit cautious. You can't just slide it away by saying, oh, this is not, and it's been 12 months. I can understand if you have had high inflation for 2 months, you can slide it away as an error. But to ignore 12 months of data, to ignore the components of this data, to ignore that core inflation is actually very, very high, in my view, is essentially saying that we are probably deviating from our legal mandate, which is to actually maintain inflation at 4%. Ultimately, I think we are not, I shouldn't say we because I'm not at the Reserve Bank of India anymore, but technocrats at the Reserve Bank of India are not elected officials of the government. They have to follow the legal mandate while performing their function, in my view.
So I guess the obvious question, I mean, what do you say to people who say that the inflation targeting regime is a bit restrictive, right? You have anemic growth and you have this hard inflation target of, as you said, upper bound of 6%. So is inflation targeting really the right policy for India, given that we have these sort of, I guess, supply side shocks and so on?
I think my question to them is, where is the evidence that there's a trade-off? India's growth has been on a downward trajectory of decline, regardless of whether inflation over that period has been high or low. India's growth was collapsing when inflation was down at 2%. India's growth has been declining when we are hit by COVID and the inflation is at 7 to 8%. I think India's growth problems are more structural in nature. They are linked to the weakness of the banking sector and the financial sector, including the non-bank finance companies. India's fiscal deficits are very high. So regardless of what the monetary policy is, the transmission of the monetary policy to the corporates and the real sector, the households, MSMEs is very weak, because the government hogs up such a big part of the savings in the economy that there's just a crowding out pressure in the cost of borrowing for everyone else. And third, I think we haven't accepted that our growth engines have been tapering off since the global financial crisis. We were doing very well as long as the rest of the world was doing very well. Since the global financial crisis, the rest of the world has slowed down, and we have not been able to find a steady source of growth, of job creation, of wealth creation in the economy, other than doing band-aids and fixes every other year in every government that has come into place since the global financial crisis. And to just turn the entire thing on its head, the whole idea of inflation targeting is threefold. One is that it will be a commitment of the central bank to prevent a sharp depreciation of the currency on the external front. So foreign money can actually come in. I think coming in of the foreign money has been a big contributor actually to funding the crowded out corporate sector of the Indian economy, to the extent that they can borrow from abroad. The rupee has been very, very stable since inflation targeting has been adopted. This is something that people don't talk much about because, until it will break down, we will not realize its value. But rupee has been extremely stable, and part of it comes from the fact that central bank has built at least some commitment to inflation credibility over the last 5 years. I'm actually glad that questions like this are being asked, which is inflation. Does inflation targeting sometimes involve a sacrifice of growth? Because that's at the heart of inflation targeting. Sometimes you give up short-term growth because you want to build long-term credibility on inflation. The second point is that the reason why inflation targeting is done is because when inflation has a tendency to run away to double-digit levels, as it did at the time of taper tantrum, etc., it significantly erodes the confidence of savers in financial savings, because financial savings get eroded in real terms when inflation is very, very high. This was the point that Raghuram Rajan tried to make in his Dosanomics famous lecture. And and what happens then? They start investing in gold. They start investing in real estate because they don't want to invest in financial assets. Maybe the stocks are a bit hedged against inflation because the cash flows of companies will also rise with nominal inflation, unlike fixed income assets where cash flows are promised at fixed nominal amounts and the discount rate keeps rising as the inflation rises. But so that's a huge problem. Why are the flows from SIPs into mutual funds, etc., so large over the last 4 or 5 years? While clearly mutual funds have made a very big push to market themselves, I think a very fundamental contributor has been that inflation has been relatively stable in India. It has been brought down. I'm not saying that inflation targeting is the only factor that has contributed to this. Clearly, food management to an extent has also helped arrest this. But clearly, I think this has been an important factor. And third, and the last important factor is the formation of inflation expectations. The way inflation credibility is built is that even if short-run inflation rises, investor expectations, household expectations don't run away too sharply towards the short-term prints, because there is confidence that the central bank in the medium term will help bring the inflation down. This keeps bond yields from rising. This prevents wage inflation from rising in the economy and then generalizing into cost of goods and so on. Uh, and certainly, while household inflation expectations haven't come down as much as we would like, they have definitely come down with the decline in inflation and with which coincides, in fact, with the adoption of inflation targeting. So I think my sense is we are, if I could use the term, I find India too greedy for short-term growth for my taste. We don't think of growth as being a great nation over the next 3 decades. We think of growth as like registering a very high print every quarter. This is not how it works. And that's why I always keep giving the analogy that it's like playing a test match. Sometimes you just have to grind it out. You score 40 runs in a session. It's not the end of the test match. You have to get your eye in, start seeing the ball like a football, and then you can do whatever you want in the next session. But sometimes you just have to dig it in, especially when the wicket is treacherous or the conditions are difficult for batting. So I think that, and it's been 4 or 5 years. That's a very small time in the implementation of inflation targeting framework. Usually, the gains from inflation targeting are realized over a period of 10, 20 years. I think we have to persevere it. And I think my main contention is that India's growth has not slowed down because of high interest rates. India's growth has slowed down because of structural weaknesses of Indian economy, which became apparent right after the global financial crisis, but which were temporarily uh, covered over or papered over because of the fiscal stimulus. Then they were covered over because we kept blaming the banking sector for the legacy loans that have been made. But along the way, we have lost our path. Other than pharma and tech services, I don't see huge contributors that have changed dramatically their growth engine. Why aren't we improving our textile sector? Why aren't we improving several of our MSME sectors where we used to have a significant presence? Our competitors have gone way ahead of us, and we still keep talking about blaming it on inflation or something like that. I think it's a wrong diagnosis in my view, at least in my limited view of things.
So you talked about capital flow. So that is my next question. So thanks to very low global interest rates, the economy has also had to contend with a glut of capital inflows. Should we worry about this in the sense that I think you've worked on this, and the papers by Bruno and Shin, who pointed out that during these periods, particularly where there's this huge interest rate differential with advanced economies, there is the worry of carry trade, borrowing in a low interest currency and sort of investing in a high interest currency. Is this something that we should be worried about? I mean, a lot of people point to our stock market and say, it's in a completely different planet. Stock market is booming, the real economy is not moving at all. Is some of this being actually driven by these sort of capital flows that we are seeing?
Yeah, I have no doubt that it is. I haven't done research that proves that the current valuations are actually linked to the foreign portfolio flows. But see, what happens is right now, and this goes through waves, the global interest rate cycle is very benign right now. Interest rates are close to zero. Real rates are negative in many advanced economies. Their central banks are expanding their balance sheets. So, as you said, because of higher interest rate differentials, a lot of hot money or carry trade flows are coming to India. And you can see we were losing flows right at the COVID outbreak. But once the foreign central banks adopted their significant bazookas, the trend reversed and we started being recipients of these flows all through the COVID phase when our real economy has actually not been performing that well. Now, this is coincident with a significant expansion of the domestic liquidity conditions and the size of the Reserve Bank of India balance sheet. Reserve Bank has also been pumping extra liquidity into the economy, and it has slashed interest rates very, very significantly to negative real interest rate levels in India at a time when our inflation is high, above 6%, in the 7 to 8% range in the last few months. So my worry is not so much just the fact that foreign money is chasing us. If our macros were benign, this would be not such a bad outcome. But I think both on our fiscal deficit front, where the numbers are probably likely to cross 10%, maybe even get closer to 14 to 15% on a consolidated government balance sheet basis. And whenever inflation has been high for a 10 to 12-month period in the 6 to 8% range, I think these kinds of excessive flows from foreign investors, excessive liquidity in the domestic economy, negative real rates, I think this is a recipe for stoking asset price inflation. So if you had to ask me to give me a proof, I don't have a proof, but it doesn't pass my smell test of whether these valuations are very robust. What happens when we have been in these kinds of scenarios? See, there's something fascinating about stock market valuation, which is that it's such a risky security to price. That no one is ever 100% sure either about the cash flows or the discount rates. Anyone who has done a corporate finance valuation project knows that there's always enough degrees of freedom in whatever models you are using, your Gordon growth model or two-stage discounted cash flow valuation model, to fudge them to meet whatever stock price there is in the market. You can always come up with factors in there to justify the stock price. What I'm trying to say is that by and large, people are trying to learn from the stock markets themselves as to, how do I update my errors? And because you are never sure, you start getting convinced that the stock market valuations must be right. Maybe the growth numbers for India are supposed to be very benign. Therefore, in my view, some little bit of earnest macro analysis of numbers helps, because it helps you understand whether you can justify the kind of price earning ratios or market to book multiples one is seeing for certain sectors purely on the basis of expected growth rates. Sometimes expected growth rates implied by the stock market really seem too good to be true or start bordering in that territory. And then you know that at least there could be frothy conditions in some parts of the market. So I'm worried not in the very short run, but I would say I'm worried when a shock like taper tantrum or something like that occurs. Suppose in 9 months or 12 months, some of the Western economies are vaccinated more fully. Suppose their growth comes back or their inflation comes back and their central banks start normalizing. Fed has indicated it may not normalize for another 2 years, but there is some risk of it happening earlier or say even in 2 years. I think the question is when that happens, will we have taken on massive imbalances in the process and whether these flows reverse? And mind you, these shocks can happen not just because the central banks are normalizing their balance sheets. Sometimes shocks hit India on the external sector because Argentina is going to default and there is a general pullback from emerging markets. Brexit, Italian sovereign debt problems, Greek problems have all played out and caused minor turbulent episodes on the Indian external sector. If our conditions are not as benign, turbulence can actually get more violent. So I think, to me, our macro doesn't look right on fiscal front, on inflation front, on negative real yields, in combination with excess global and domestic liquidity, and the fact that we have these other two conditions on fisc and inflation. And so I tend to be more cautious in swinging for growth all the time. I think growth should be thought of at a very high horizon. I think poor people pay the most when we have a bad crisis, as they are even right now. I think the youth pay the most when we have a crisis because new jobs don't get created, whereas those who are in existing jobs have greater stability with their jobs. And so I think we have to keep that in mind while taking these risks.
Yeah, so one of the things that we've observed, of course, is that our stock of international reserves has been increasing. But I think in your book, you point out that this itself might prompt risk-taking behavior, on the part of investors, for example. And so you advocate a combination of capital controls and international reserve management to combat this capital inflow problem. Can you sort of elaborate a little bit on that?
Yes, so the basic idea is very simple, which is that essentially the central bank stock of reserves is used primarily to stem the currency depreciation when a situation such as a taper tantrum or the kind of scenarios I was describing, like a sovereign default outside or a Federal Reserve balance sheet normalization, starts pulling out funds from India. Of course, it may combine with weak macro conditions in India as well, in which case the outflows will be more violent, as I was saying. Then the Reserve Bank of India steps in because it has this long stated policy of smoothing out excessive volatility. Excessive volatility tends to be more on the downside for the rupee. As the saying goes in the currency markets, emerging market currencies go up the step ladder, but then they come down the escalator. They kind of rapidly collapse. The central bank reserves are basically like a put option. They are a guarantee to international investors that when they are seeking to exit, the central bank will step in and prevent the depreciation from getting far worse. Now, preventing the depreciation, while in many cases advantageous to keep the Indian import costs low, it is also easing the exit of foreign investors because otherwise their value would have been eroded a lot further before they were withdrawing because the rupee keeps depreciating as they are unwinding. So what happens is, beyond a point, the reserves start attracting flows in themselves. For every dollar of reserves that you add, there is a dollar of hot money on the other side. And if you do that, you haven't actually achieved much. You are not going to be able to get any extra stabilization because, yeah, you got $1 in, but that same dollar is going to be paid with your reserves. And in fact, if anything, you have increased the stock of your negative net international investment position. India's net international investment position is substantially negative, probably close to 800 billion, 900 billion when you include bond markets, equity markets altogether. Our reserves are on the order of, I don't know right now, $550 billion or even higher. On an import cover basis, it looks very, very comfortable. But the question is whether it is comfortable on a flow basis when it comes to dealing with these hot money flows. As we were just discussing right now, global liquidity taps are all open. So liquidity is flooding the entire system, but it can vanish fairly quickly. And I think we will know only at that time whether the reserves we have built are adequate to deal with this hot money flows, or many of these flows are sticky. See, if reserves were built entirely out of, say, FDI money, it would be very good because FDI money can't leave that quickly. It's come with a long-term horizon. It is relatively illiquid. You can't sell equity other than in our blue chip companies at a very quick notice. But that's not true. A lot of the reserves are built on hot money flows, and that is the reason why it's important to pay attention to the macros in spite of our high reserves, in my view.
Okay. Okay, so coming to fiscal deficits, about which you write about extensively in your book. So one of the, I think, for me at least, most striking features, most interesting features, the connect that you make between fiscal deficits and financial instability. So you point out, for example, rising deficits lead to lax default disclosure norms. And the idea being that disclosing would require banks, which are typically public sector banks who have lent to these firms, to budget for more capital, and this in turn would put pressure on government finances. So it seems like fiscal consolidation, at least that's my sense, that you're arguing that fiscal consolidation is almost a necessary condition for financial stability. So has COVID with its pressures on government expenditures made this more difficult? So are we in for a period of financial instability? I think you're muted, Viral.
Yeah. Two things I would say. One, in India, financial stability plays out in a very silent way because a big chunk of our banks are owned by the public sector. Typically, Indian banks are not allowed to fail, as we have seen in the form of the rescues of Yes Bank and recently the Lakshmi Vilas Bank, etc. So I would say one has to take financial stability in India in a broader context, the way I'm trying to describe in the book, which is that ultimately it's about whether banks and the financial sector are performing their core intermediation functions well or not. It's not good enough that they are not failing. The criterion has to be whether they are intermediating well to the rest of the economy. So on that front, I am concerned. I think India's credit growth remains anemic. It is not that high. Our overall credit to GDP ratio is still below 60%. So it's not that our credit growth is anemic at a very high level. We are also at a very low credit to GDP level, which means under penetration of financial services to a big part of India. But I think the things that are worrisome on the fiscal front are, I would say, many, but let me just point three. First, that as the fisc has expanded over the last 5 years and continues to expand for the unavoidable reasons in the midst of fisc, the pressures of fiscal dominance on the central bank will grow to keep interest rates low, to pump in a lot of liquidity, to make it easy for banks to hold government bonds by allowing them to not mark to market these bonds, etc., etc. And all of these have already happened. Whether we call it fiscal dominance or not is a matter of euphemism versus being frank about it, frankly. And what that does is, it does deviate the central bank from its longer run targets, such as maintaining price stability, for example. Second point, we have always used banks, insurance companies, pension funds as vehicles to buy a lot of government bonds. As Dr. Reddy in his masterful foreword to my book says, that the RBI, the government, and the public sector banks in 70s and 80s used to be like a Hindu undivided family in which no one kept anyone's accounts. RBI was buying treasury bills of the government at every auction. The liquidity requirements, the statutory liquidity requirements were kept at as high as 30 to 40%, so that every rupee of deposit that went in was used significantly, basically to buy government bonds and fund the fiscal deficits. We could easily get back into this territory, in my view, because there is no way that you can sustain 10 to 15% deficits on year after year basis without actually engaging in massive financial repression of the economy, which is that you're going to steer savers through the intermediaries into government bond markets by fiat and not allow the private sector borrowing, lending to MSMEs, lending to retail to happen on a level playing footing. So financial repression is a real cost, in my view, and that will actually act as an end against growth, because the growth being generated just through the government machinery is not going to get us back to our potential growth. Our potential growth just on the back of government should be marked to maximum 3 to 3.5%, which was the Hindu rate of growth that we achieved in 70s and 80s. Why is our growth ambition now 7, 8, 9%? Because we've actually liberalized the economy. But then you can't have a potential output growth estimate, which is based on an economy which is private, but then a government which is becoming so large that it is leaving no space in the economy for the private sector to be financed in the first place. So I think there is actually a dissonance in the macroeconomic discussion, which says that we need the government to become larger, and yet to say that our potential output growth rate is actually very, very high. Okay, how are you going to fund the private sector if the government actually keeps doing all this? You can't ignore the set of policies that the government adopts when it has a very high fiscal deficit and debt to GDP ratio. And third, let me echo the point I have made already earlier, which is that high fiscal deficits in India tend to be associated with very high fuel taxes. And I think a, this is a pressure that very quickly generalizes into core inflation. And it has, in my view, a great potential to destabilize us on the external sector front when the shocks arise. And I think that I would consider external sector stability as part of the broader financial stability. So I would say fiscal situation is, I give it so much paramount importance in the preface chapter of the book because I think it affects financial repression, it affects crowding out of the corporate sector, so it affects growth in a direct way. It affects banks in a very direct way because bank regulation gets compromised and they are forced to earn very, very low returns, which reduces their margins, their capitalization, and their stability. And third, the fiscal situation makes India unstable on the external sector front because it also goes in the wrong direction on inflation. So I see only a downside from India's fisc in the near and medium term, unless we adopt significant structural measures to keep the deficits reined in down the line. It will require compression of wasteful expenditures, more growth enhancing expenditures, and a commitment on part of the government that as and when growth rebounds, they will get back on a path of consolidation rather than using fiscal jugards to hide the government borrowing in different PSU balance sheets and so on.
Okay, so I guess you've already answered my question, but let me ask it anyway. So I guess there's a sense of, where is the growth going to come from? So you look at your standard GDP equation, C plus I plus G plus net exports. And it seems like, the COVID shock is like a permanent shock. And so you're likely to see consumption actually not pick up for a while. Exports are going to be sluggish because the global economy is slowing down. If there's no demand, namely there's no consumption, there's no exports, there's not going to be any investment. So I think a lot of people are pointing out, well, the big driver has to be government expenditure. And I guess people are saying, well, infrastructure expenditure because it has big multipliers and so on and so forth. But I guess as I said, you've already probably answered my question. So suppose this were to be the only way out, how does fiscal consolidation take place? How does the government actually finance these so-called big multiplier infrastructure expenditures and so on?
Yeah, I think it's a difficult question, Chetan. I don't have a silver bullet to this question, to answer this question. But, if I could just use a tennis analogy. So last week I haven't been playing very well. I've lost a few matches, and I've been reflecting on what I need to do differently. And ultimately, the only solution you reach when you are not playing very well is that you have to go back to the basics. You have to start doing your drills all over again. You have to get your backhand, forehand, your point construction, etc., in better shape. And what I'm trying to say is that you just have to get your game structurally right, even for growth. So when things have been falling off the cliff, probably for a decade, but at least for the last 3-4 years in a row, there are no quick fixes. It means you have not been doing well on multiple fronts. Just one aspect of your game failing would not actually cause you to have a growth decline for several quarters in a row. So my suggestion is that India should plan for the longer run and think about a fiscal reform package. It should plan for a financial sector reform package that should involve very significant banking sector reforms. Both fiscal and the financial sector reform packages are likely to involve, in my view, if done right, massive disinvestments by the government, dilution of its stakes, allowing the private sector to run a large number of public sector enterprises, after fixing the governance of our banks, perhaps even allowing private sector to run some of the better public sector banks. And third, through infrastructure expenditures, through investments in education and health, it can catalyze the private sector growth to be better. It can improve the productivity of Indian workers. It can improve the ease of doing business in India. I think the farm bills, the labor bill are a step in the right direction. We perhaps need a land rights bill if foreign companies are going to find it attractive to come in and set up the shop here. Right now, they really can't deal with land issues very well. The only way they can deal with it is if they partner with an Indian company that has the know-how of how to bribe the local municipality, etc., to get your licenses. I have spoken to my IT friends in India. None of them are able to operate, even to get rental space, without actually bribing the local guys. Once you get to acquiring land, it's an altogether more complex operation altogether. So I think we need to think about getting back to basics, that an economy grows well when it is in a structurally sound shape. What does that involve? Productivity has to be high. There has to be ease of doing business on the ground. You need to have a healthy banking sector and non-bank financial sector. You need to have a well-functioning bankruptcy system. You need to have fiscal deficits which are in ordinary range rather than in extraordinary range. And you need to have inflation at reasonable levels so that people continue to remain attracted to financial savings. So it's going to be a long slog, in my view. I really think we have to play a very good test match coming out of this shock, partly because we have been doing poorly in the series, even in the last, taking the sessions of the last 2-3 years of slowdown in the Indian economic growth. And we have no way out, in my view, because we have to create several millions of jobs every year. We have to continue to eradicate poverty, given the levels of per capita income that we have. And I think if we don't do it, who's going to pay this huge burden of debt down the line? It's a huge intergenerational transfer that the current generation is making. Of course, it's being made by the technocrats and the appointed officials on their behalf. But I'm significantly worried that we are leaving the Indian children and youth with very huge quantums of debt to deal with because we are so greedy for growth in the short run. I think we can't do that. I just think morally, I feel that we ought to leave the country in a better shape than it is now, rather than burdening them with all the debts, inflation, and other problems that we want to take on in order to satisfy our short-term needs for growth.
So with a last question, I think we're almost out of time. Of course, the big problem, one of the big problems in the Indian context is the rising NPAs, and the recent RBI financial stability report says that the GNPA ratio is likely to rise to almost 14 to 15%. And of course, you've in the past, and I think there's an paper with Dr. Rajan, which is gathering a lot of attention, where you've sort of called for the creation of a bad bank. And one of the impediments to the creation is the absence of reference prices for loans. And I think what you've recommended is a secondary market for loans, so that it discovers this reference price. Can you just walk us through this argument?
See, this idea was really based on South Korea's experience during the East Asian crisis. So several of the Asian countries also had very large bad loans on their banking sector debt. The mop-up costs were so large, sometimes reaching, I think, 50, 60, 70% of GDP, that they actually privatized their financial sectors in a very, very massive way under duress. And then they had to also still resolve the bad loans because a lot of corporates had actually taken on excessive short-term debt. So what South Korea did is it set up an agency which looked technically like a bad bank, but it wasn't. It was actually more like a utility. What it did was that it was called Camco, a Korean asset management company or corporation. And what Camco did is that it provided great transparency on loan contracts, and it created a market for auctioning the loans and disseminating the prices of these loans. To start with, it was doing this more for distressed loans, and it attracted a large number of foreign players into the country because there was this utility which was actually guaranteeing price transparency and standardization in the digitization of the loan contracts. It was very transparent as to what these are and so on. Right now, what happens is when Indian banks try to get rid of their bad loans, they put out like each individual bank puts out a call. It receives sealed bids. The bids are not really revealed in the end. If they don't accept the offer, then you learn nothing about what the bids were, other than that they were below whatever reference prices that they might have been interested in earning on the sales. So it's a very opaque, illiquid, and non-standardized market. And our idea was that if we created a loan sales platform the way it exists in the United States, even for high quality loans, even high quality loans in the United States get sold on a daily basis. In Korea, Camco has now emerged into a full-fledged utility which is providing this platform for loan sales. I thought that it could be useful to get some reference prices by sector, maybe by size of the firm, etc., etc. And I think in the Indian context, it may be particularly valuable because our bankers, especially the public sector bankers, often claim that they don't engage in many of these sales because the price at which they sell could be questioned by the three C's, as they are called, the vigilance, the enforcement, and the CBI and all that. Now, if the prices are being determined in a market, see, no one questions a bank for buying government bonds because it's buying it in the market at a price which is at a reference price for which is established every night by FIMDA or FBIL now, Financial Benchmarks of India Limited. So I think benchmark prices do have a value because they reduce the burden on the parties that are transacting to prove that these were actually the right prices, because there would be a third party or a utility certifying that these are the reference prices at which it happens. And in fact, this applies even to the bad bank, because the bad bank to start with is likely to have government support. It's likely to have a government appointed administrator or an asset manager. And the bad bank also has to acquire these loans at certain prices. Now, if that process is not streamlined, someone could question the asset manager running the bad bank, which is, did you acquire these loans at the right price? Now, if the bad bank is acquiring bad loans from a public sector bank, you could argue it's all within the same pocket. But bad banks may be acquiring assets even from private sector banks. And then these vigilance issues may become even further important. So I think it's a relatively simple thing to do. I think it is something that the Reserve Bank of India and the Indian Bankers Association may have to put their heads together to develop. I had been pushing this idea all along while I was there. It may or may not be taken up, but we wanted to just reiterate the idea all over again. Sometimes when you work at these entities, you find that, like me, perhaps, but everyone who comes in wants to leave a legacy of their own. And so sometimes when they quote unquote throw you out, they also throw out the good ideas with you. So I hope that's not the case. I hope that some of these ideas can be taken up and taken to the natural completion. That was just an exaggeration. I wasn't thrown out. I left myself. But I'm just trying to say that sometimes there's a tendency in these organizations that the last person who walks out has to walk out also with their good ideas, but that doesn't have to be the case. I think institutions should build for continuity in ideas rather than continuity in individuals.
Okay, so we're almost out of time. Can I open up questions to the audience? Do you have any?
Yes, Professor. So,
yes, please go ahead.
Yeah, sure. Just give me a second. We're almost out of time, so I'll just take one question from the audience. The question that we have is, how do you think the cost of capital in India has factored in the growth of MSMEs, and how the recent economic package offered will change the status quo?
I think the cost has been one of the major impediments to the growth of MSMEs, in my view. So in India, there is this middle tier that can't borrow well, because when you have undercapitalized banks, they are either lending to the most distressed companies because they want to evergreen these assets and not recognize them as bad loans or non-performing loans. So you get extending of maturity every time the loan is coming due, and the bank pretends as though everything is okay. So undercapitalized banks either do zombie lending or they do lazy lending, which is they just keep buying government bonds because government bonds don't require any capital to be added to your balance sheet. And then they hope interest rates will come down. They lobby for interest rates to come down so that they can make treasury profits to keep looking well capitalized. And this has partly happened during our interest rate cut cycles. So the middle tier, which is the healthier firms in the economy, are never actually borrowing at reasonable costs, in my view, barring when central bank has provided such easy liquidity as it has right now. So, with such high costs of capital, of course, it's not easy to survive and do well. In fact, I think that the high costs of capital, the capital in India also gets taxed many times because, there's just a whole layer of taxes you pay in India at all points of time. You can just go through a property transaction to get a sense of how many layers of taxes you are paying. And some states in India have stamp duty that is as high as 8 to 10% or even higher actually to do a property transaction. So when you factor in all these costs, you can see why Indian companies are so keen to evade taxes, because they need to actually somehow generate money and generate enough profits along with it to ensure that they are crossing their hurdle rates of investment. Evading taxes is almost like a way that they ensure that they are generating some bottom line on top of the high hurdle rates that they are facing. But I would say that this has not been the only issue. I think our ease of doing business on the ground has not increased. Take the example of our textile sector, for example. I'm told, I have not done this research myself, but I'm told that an average factory in Bangladesh produces 4 to 8 times the number of shirts and trousers, on its per plant or per unit capacity than the Indian factories are. Now, is this lack of investments? Is it lack of productivity of labor? Is this very high hurdle costs? Is it lack of scale? I don't know what the correct answers are, but our MSMEs are not looking globally very competitive. One interesting idea that Professor Arvind Panagaria from Columbia has floated, which also finds some support in a study by McKinsey of how emerging markets grow fast, is that ultimately emerging markets need a large number of successful large companies. And so the large companies are the ones who are able to be globally competitive. They have lower costs of finance, they grow fast. But along as they are growing, they pull the MSMEs who are the suppliers to them along with them. And so what Professor Panagaria and this McKinsey report are saying is that you need to facilitate smaller companies to constantly keep growing to become larger companies and becoming globally competitive. And along with them, they will pull along several smaller companies. Of course, you don't want that 5 companies are owning the entire economy and they are the only ones doing this and no one else can ever become large thereafter, because then you stagnate. They will not remain thriving as much. But I think there is something to it. I think India's approach to MSMEs has been to constantly accommodate them. I believe the Reserve Bank of India has adopted a forbearance scheme for non-performing assets in MSMEs every year for the last 5 years, maybe sometimes even twice a year. This is not a long-run strategy. You can't say that even if an MSME defaults on the bank loan, I will not call it a non-performing loan so that it can continue to borrow. This cannot be the pathway to having a thriving MSME sector. Maybe it was justified post demonetization, but we seem to keep doing it every year. We know it's a huge lobby in the country. It's also a big vote bank for the present administration. And so we know where these policies come from. But, maybe once, twice, 5 times in a row, really, is that the way, is that your growth strategy for the MSME sector of the country? So I think I go back to my earlier point. I find India reasonably confused in how it wants to become a great nation for the next 2-3 decades. I don't see any clarity in our economic model or in our growth engine. It is full of band-aids and short-term fixes. It doesn't resemble the quality of institutional development and sound foundations. As I said, being structurally right with your game. That should be our focus. And we are very good. We are excellent at rationalization. I think that's what I have found. Every time I tried to propose something which was a bit longer term, it was very quick for people to tell me, oh, they would politely say it's academically it's an excellent idea. Basically it was to say that, we don't like to do what is the right thing to do. You have to be practical. You have to find the right solution. And, the right solution in India is usually some kind of jugaad, bend this law, bend that rule, don't recognize bad loans of banks, give some temporary tax relief to someone. And, we keep doing this over and over again because we are so, as I said, we are too greedy. We just keep focusing on playing a T20 well. And, sometimes you have to play a T20. Yeah, in the midst of a COVID, even the next quarter is very important because you're falling off the cliff. But if you keep playing T20 all your life, you can't really do well. People tell me, oh, you keep giving example of Rahul Dravid, but that's in the past. Now we have a Virat Kohli. Yeah, but okay, then show me a Virat Kohli in the Indian economy, and I'll shut up.
Right. Thank you, sir. Thank you, sir.
Okay.